Welcome back, guys, to another video. In 2022, we saw high volatility in the stock market. We've seen the lowest stock prices we've seen in years, and we saw high interest rates that put a lot of people out of the market. And then we saw overall just less money in people's wallet, which leaves us wondering what next. Is the housing market headed for a market crash? So in today's video, I'm going to share with you some market indicators in the current housing market and help determine what market cycle we are headed for. Is it a declining market, an equilibrium market, or are we headed for a crash? So let's get started. It's very important to note that a market crash is not a single event. It's a series of factors that can impact a market to go into a crash. So we're going to discuss factors and indicators that are happening in the current market or that have happened also in the past and make some conclusions from that to find out what marketing cycle we're in. So let's get to the board. So here are some crash factors that we saw in the last crash of 08 and then the housing crash that we saw in the 80s where inflation was sky high. Number one, this is one of the main factors that impacted the 08 crash was that there was just surplus of inventory. There was about 6+ months supplies of inventory sitting on the market where there was absolutely no demand. Nobody was buying homes right when the crash happened. Homes were sitting on the market for almost 6, 7, 8, 9, even a year on the market. And in that time, we noticed that there was more existing homes. When I say existing homes, that means not new construction, homes that are already built and are not new construction. So a lot of existing homes were on the market. And that is not the case in today's market, where in today's market, if you are, it also not, each different local market is different throughout the country, like I've mentioned in my previous videos. So your market may be different from the market here I am in the East Bay area. So you want to know your market, but overall in the US market, there are just not enough existing homes on the market. Because people are not putting their homes on sale, a couple of reasons. Number one is that they're expecting sales to be where they were in 2021 or on the beginning of 2022, and their professional agents are recommending to them that we can't sell the home at that price because the market is just not there. So they're holding back. Another reason is high interest rates out there. And so people are just holding back from selling because they're thinking like, well, after they sell the property, where are they going to go next? So right now in this current housing market, there's just not enough inventory still because people are holding back on existing homes. Now, new construction already had that supply chain distortion that I've talked about in my previous video where appliances weren't coming in, supplies weren't coming in, so they were kind of, backdated. So you could argue that if you looked at an average, there are about 4 to 5 months of availability of homes in new construction, but builders are doing a lot to get those homes off their hands and people are buying. Now, new construction is not popular in every area. Like here in the East Bay area and like the city of Hayward or Fremont, Union City, Newark, there's not really that much new construction. Now, if you're in Austin, Nashville, Tennessee, and some of those markets, you're seeing new construction, but overall, there's just not that much inventory as there was in the 08 crash. Okay, moving second to the second point. A big thing that happened in that crash was that people were not able to afford their mortgages that they had gotten on their home because there was a lot of foul practice happening. There was immoral activities happening in the lending world where banks and mortgage brokerages were just lending, or lending institutions were just lending money by when people just signed a piece of paper. And then a lot of these loans were actually adjustable rate mortgages, but they were sold as if they were fixed rates. So when people that were uneducated and were veered into doing this, signing a piece of paper and getting this house, when those payments came about, or those balloon payments came, and now they had the rates just skyrocketed, they were not able to afford the mortgage payment and they had a major payment shock. And that's why a lot of people in that time had to short sale or foreclose their homes. And that's another factor that really added on to the surplus of inventory because all these homes came on the market and there were just not enough buyers. So right now, that is also not the case on a mass level. I'm not saying there's foreclosure or short sales not happening anywhere in the country, but you can't really quantify it at the level that was happening during the crash, because now you have a lot of people that locked in very, very low rates in the last few years. And after the Dodd-Frank Act happened after the crash, where a lot of lenders got a grasp of their lending practices, and that foul practices that were happening before did not happen in this previous marketing cycle. So people that got mortgages mainly got 30 to 15 year fixed mortgages, and there's a less of a risk of people defaulting. Now, there are some X factors that I've discussed in my previous videos, which we'll go into in a second, but this is not a market right now that we have fear of having major payment shock, because people have just locked in mortgage rates at a very, very low rate at a long term. Okay, moving forward now to rate hikes. So this is another factor. Like I mentioned, there's multiple factors that can impact and lead to a market crash. Rate hikes is another one, and we're seeing that happening right now. Shooting this on January 5th, rates are somewhere in the low sixes, depending on what scenario you're in, how much down you're putting, and how much credit score you have. We might be able to get a rate in the mid fives or the high fives, but let's just say for talking points, the rates are sitting at 6%. Now that is almost double what the rates were at almost a year ago or a year and a half ago, where the rates were at. Now, this has caused a lot of people to just be priced out of the market. It's definitely lessened the buyer demand in the market. But now again, if you go back to my first point, which is one of the main points of having surplus inventory to have a crash happen, there's just not that much inventory available out there. So rate hikes are there, they're impacting and slowing down the market. It's gonna be interesting to see. This is one of the X factors that I talked about. It's gonna be interesting to see where these rates go. Now, if the Federal Reserve is not able to get a hold of inflation, right now it's around 7%, the target is 2%. If they see that it continues to go up, right now it's been coming down a little bit. If it continues to go up, they may continue to do more aggressive rate hikes. Now, if the rates go from 6% to 9% by July, and nobody really knows this, then this topic discussion is going to change here, and this is going to be one of the X factors that can contribute maybe to a crash. But right now, we're not seeing signs of that, because all we're seeing is it's just lower demand, and home prices are still holding strong. Then my last is economic recession. Recession is defined as the GDP lowering for 2 consecutive quarters. Right now, we don't have the Q4 data yet to look at, but for the previous quarters, we saw that the Q3 GDP was higher than Q2. So in technical speaking terms, we are not in a recession yet. Now, a recession is a slowdown or economic slowdown where people start to lose jobs, the assets start to lose value, like the stocks start to drop, and people just have less money in their wallet. Now, that is sort of happening, but like I mentioned, technically speaking, on paper, we're not in the recession phase yet. Now, that's another X factor. Now, if you haven't checked out my last video that I did, click the link above where I talk about the overall economy and what we're really expecting at a macro level when it comes to the housing market of 2023. So check that video out. I talk about these X factors. But to stay on topic here, it's going to be interesting to see what the future holds. More layoffs, what the future holds for the stock market and overall economy. So as of now, technically speaking, we're not in a recession. If you are really enjoying this video and would like to have more content like this, please hit the subscribe button. And thank you so much for having confidence in my content. Now, moving forward, let's see what housing market cycle we are in right now. A marketing cycle is a series of ups and downs that a market experiences, and it's characterized by economic growth followed by economic contraction. So let's go on the board real quick to look at a typical marketing cycle and the sentiments and emotions tied to this cycle as things move along the cycle. So here it is. And you could argue and say that, there are different types of marketing cycles. Depends on what marketing cycle we're talking about. For example, let's just talk about the market that we all saw, talking about the stock market, right after COVID-19. We saw excitement, the price, everything was on a halt, stock market was kind of slowed down, real estate was slowed down, and then all of a sudden money started being flushed into the economy. The Federal Reserve pumped in a lot of money and we saw excitement. And then we saw more excitement, euphoria, all of us orgasm together. Excuse my language. This was the peak of the market. Everybody was buying stuff. People were buying stocks. People were buying cars. Companies were expanding. Everybody was just, on this wagon and on this hype. And then we saw just this come down. Stock prices came down. Remember, I'm not talking about the real estate yet. I'm only talking about stocks to kind of explain how a cycle really runs. And then we saw anxiety here. We saw fear come in. Some people lost 80-90% of their stock portfolios. All the cash that they had in, say in RSUs and from that they had got from their companies all came down to, in a lot of cases, 50-60% decline. And prices went back to pre-COVID numbers. So, and then, we had fear and there was also some panic. And now things are starting to come up where people are starting to have faith again. A lot of people, nobody knows if the market has bottomed yet or not. And that's the thing about marketing cycles. Nobody can predict them. So that's why you see here, and this is not something that I invented here. This is something that economists talk about and Wall Street folks talk about all the time, is that when we're in this orgasmic euphoria stage, that's where it's the max risk. But when we're up there, nobody really knows we're up there, because, and like I mentioned, all of us are just on this hype. In my business, I probably saw the best years of my business that I've ever seen, and I thought I was going to stay there. And I had practices that I shouldn't have had because I had no idea what was coming next. So that's why it's max risk area here. So it comes down, then there's anxiety, then there's fear, then there's panic, and this has happened. It's a term that they use. It's called capitulation. And what that means is that there's panic and fear, and there's downward pressure on prices because there's scarce of buyer demand, because the money flow has just slowed down, or whatever the natural causes are, the market causes are, it's slowed down. So people start to sell their portfolios and start liquidating. We did see that in the stock market. We haven't yet to see that in the housing market, but I'm doing this to just kind of explain the whole cycle here. So going forward, we come here, and I think we're not here yet, even in the stock market. We're kind of somewhere here where people are buying and still thinking that the stock market may still hit a further bottom. Nobody knows. So here is where the max opportunity is. And as we saw in the '08 crash, a lot of people were not buying, but there were some investors that were picking up properties and they were taking max opportunity, taking advantage of it here. Now, if people really could understand and know how the market's going to perform, a lot of people that foreclose and short sale, they probably wouldn't have done that. They probably would have done everything in their power to just hang on if they knew that it's going to rise back up. But when we're in it, we just don't know what's coming next. So after depression, you have hope, relief, and we're back to optimism, and then hopefully somewhere up there we're in the orgasmic stage again. So this is a typical marketing cycle. Now let's see where we are when it comes to the housing market. So we've already talked about the euphoria stage, and where we were at the peak. Now house prices have yet to see a drop in price value on a national level, and we've seen demand significantly drop, but we have yet to see home prices come down. I feel that we're somewhere in between euphoria and maybe a little below right here, between anxiety and fear. We're not in the fear stage yet, and we're not fully dropping yet because home prices are hanging on strong so far. Now, if those X factors kick in, different story. But again, like I've mentioned here earlier, no one can predict markets. Markets do what they do. So we're here right now. This is going to be an interesting thing moving forward to see where this goes. Do we come down and there's capitulation happening in the real estate market, or do we kind of have a little bump and come back up? Now, some people may argue and say this is not how it always looks. You're right. Like down here, it might look like this, or somewhere here, it might look like this. But if you pulled out and looked at a marketing cycle, it's going to look like this. And that's why it's very important that we play the long haul game, because to predict a marketing cycle is a loser's game. And like I mentioned, people that were in this when we were in this stage, economists and experts out there were not able to predict what's going to happen next. According to this recent article put out by Bloomberg, they state that most economists were not able to predict the 2022 housing living crisis, and nor were they able to predict the double-digit market drop in the stock market. The author writes, "Still, humility is the order of the day for prognosticators who largely failed to predict the 2022 cost of living crisis and double-digit market losses. This time around, the consensus could prove badly wrong once again, delivering a host of positive surprises. Goldman Sachs Group Incorporated, JP Morgan Chase and Company, and UBS Asset Management, for their part, see the economy defying the bearish consensus as price growth eases, signaling big gains for investors if they get the market right." So let's face it, that timing the market is definitely a loser's game. Your chances of timing a market are slim to none. I'm not saying people in the stock market haven't done it and the real estate haven't done it, but the chances of an average person timing it is very, very difficult. And you are buying a home for your lifestyle. You're buying a home, and you must play this game for a long time horizon. Otherwise, it's definitely a loser's game. The market's going to do what it does, but we can control our reaction to our emotions that we have depending on what cycle we are, and prepare for what is to come, because we really are up against a force of nature. So looking up here, if we are sitting right here, and depending on what happens, like I said, nobody really knows what's going to happen. We have to really watch the market closely. We've made some predictions there, but if there's X factors like rate hikes and economic recession comes in because we're not able to control inflation, and we're headed down here into the anxiety phase and fear and panic, what we really have control really is going to be how we prepare and our emotions. So definitely turning anxiety into curiosity is going to be very important, where you're keeping your eyes open now to see what opportunities are available in the market. Can you look into commercial real estate? Is there some stocks that you can buy? Can you look into some indexes? Can you save? Can you budget? What are other people doing? So being curious is very, very important, and not allowing this anxiety to turn into fear. And a better word for this would be caution, where if you have to play, you're playing defense, but your eyes are open. You're saving money, you're budgeting, and you know that markets are going to do what they do, and not allowing fear to further lead into panic. So converting panic into preparation. Sorry, my handwriting is nasty there. We'll throw it on the board for you. Preparation. Where now you already are saving, budgeting, but what else can you do? Can you get an education? Can you learn? Can you read online? Because what is different in this market that was very different in the '08 or the previous crashes is that the internet was not this advanced. Now you have AI learning, you have you have YouTube, you have Google, you have all these platforms that you can learn from that were not available. So just staying abreast and keeping yourself up to date with the market is very, very important. Again, we can't control the market, guys. We can only control our reaction to it and staying prepared. That's all I have for today's video. It is going to be a slow market in 2023. We are not going to see crazy growth in any market. That's something that I have a great feeling about. So realign yourself and stay prepared. And I'm going to say this again. It's very hard to predict this. Like I mentioned earlier, people were not able to predict the highs and the lows, and not able to take perfect action. So the only thing you can do is run your numbers and stay prepared. That's all I have for today. Please let me know what you are feeling and what you thought about what we discussed today, and what are your thoughts about the current housing market and where is it headed in 2023? Please leave me a comment below because I'd love to hear from you. Until next time, this is Karan Singh.